Hello. So today let's continue. We are on partnership, and in front of me is the question that I want to quickly go through with you today. Yes. The question reads: Banda, Hara, and Zulu are trading as partners, sharing profit and losses in the ratio 5:3 respectively. Interest on capital is 8%. Partnership salaries are paid to Hara 90,000 kwacha per annum and Zulu 70,000 kwacha per annum. Information is available on 31st December 2018. Okay, so the capital account is looking like this for these guys. Banda invested 300,000 kwacha, Hara 50,000 kwacha, and Zulu 150,000 kwacha. Then the current account is looking like this: Banda, Hara, Zulu, Banda, Hara, Zulu. So Hara has a debit balance and doesn't have a credit balance. A debit balance in the current account means somebody overused their benefits. They no longer have the benefits in their in that current year. Okay, so a current account is merely an extension of the capital account. Exactly the way the capital account behaves, that's how the current account behaves. The capital account normally we record from the credit indicating the money you have, the money the business has. Same goes with the current account. If the individuals have debit balances, have credit balances, it's indicating they have benefits. But Hara overused his benefits, so he has a debit balance in the current account. Then the drawings account is looking like this. These are the drawings these guys made. Banda made 195,000 kwacha, Hara 80,000 kwacha, Zulu 140,000 kwacha. And then the other information available is that computers at cost, that amount, office equipment at cost, that amount, allowance for depreciation at 01/01/2018. We have computers, that's 18,000 kwacha, office equipment 14,500 kwacha. The sales value is 1,622,090 kwacha. And then purchases, that's the amount, and inventory, opening inventory, that's on 1 January 2018, 340,635. Selling and administration expenses, this is the amount, and the allowance for recoverable receivables coming to 4750. All right, let's read more with the information that is available. Okay, so the trade payables, we have 192,400. And receivables, we have 256,600. And then cash at bank, we have 26,070. The following information is available at 31st December 2018. We have inventory at 31 December. So by 31 December 2018, at the end of the year, this means closing inventory 371,115. Administration expenses are paid in advance for 1340, and increase the allowance for recoverable receivables to 7,000 kwacha. And then number 4, interest on drawings. Banda was charged 1,500 kwacha for withdrawing from the partnership, and Hara 1,000 kwacha, and Zulu 1,200 kwacha. Depreciate computers by 14,000 kwacha and office equipment by 5,500 kwacha. The question here required is from the information given above. Number one is prepare the partnership statement of profit or loss. Prepare the partnership statement of profit or loss and appropriation account for the year ended 31 December 2018. This question carries 10 marks and a half. Second question is prepare the current accounts for the partnerships, for the partners. That's 3 marks. And then the last question is prepare the partnerships statement of financial position as at 31 December 2018. And this question carries 6.5 marks. All right, so quickly, I'll start working out this question. Hold up and make sure you follow through the steps to answering this question. And as you are working out this question, please jot down the entire question and the figures so that it may make sense to you as you work through this tutorial. And you should watch it slowly at your own pace, understanding. All right, so the first thing you do after reading the question, you do the workouts, the workings. Okay, so you find that on the information and the additional information that was given, you needed to make these working out to adjust the figures necessary according to the additional information given. So the closing inventory is that figure. The administration expenses, when you do the working out, you're going to subtract the one which was prepaid, 340. Prepaid because it's not for that period, it's for the next period. So you can't use it in the accounting year that you're doing your calculations. So the expenses will come to that amount, the administration expenses. So increase in allowance for irrecoverable debts, you discover that the allowance for recoverable debts at first was 4750, but the additional information is saying increase to 7,000. So you do the subtraction, you find that the increase in allowance for recoverable debts will come to 2250, and then receivables expense 2250. Then the interest on drawings, this was given direct from the additional information, no need of calculations. Then the accumulated depreciation, you need to make calculations as you are able to see on my screen. The accumulated depreciation is going to be used in the statement of financial position to reduce the cost of assets to come up with net book value. Okay, net book value. So the net book value, as you can see, will be like this: computers at cost, and then accumulated depreciation, you less the net book value for computers will be the 10,000 kwacha, and then the office equipment, you less the accumulated depreciation, the net book value will be 8,500 kwacha. So the non-current assets we have in this question will be valued at this amount when we come to the statement of financial position. Then the interest on capital, that 8% that the question gave us, when you do the 8% on the different capitals for these guys, the amount on the interest is going to be like this. So actually the interest on capital in partnership is a benefit to each partner. They are given back some percentage based on the amount they've invested in the business. So this interest on capital is again in the current accounts. It appears in the current accounts, indicating the gain. It's credited. Okay, anything credited in the capital account, meaning the current account, indicates the gain by each partner. So we'll come to that. You see what I mean when we work out the current account. Okay. All right, so the statement of profit or loss and appropriation account for the year ended 31st December 2018 is supposed to look like this for the partnership. The sales figure, just the normal way that we prepare the statement of profit or loss. So the sales figure will come that side. We didn't have sales returns, so no subtraction from the sales figure. It's the whole amount which will go that side. Then the opening inventory as usual, the purchases, and then you subtract the closing inventory which was there in the additional information, and then the total cost of sales will come to this amount. You subtract from the sales to come up with the gross profit. Then if at all we had any income in the question, I'm sure you are aware, you need to add here, okay, before you start subtracting the expenses. But in this case, we didn't have any income, so we went direct to subtracting the expenses. So the expenses we had was allowance for depreciation, which they said 14,000 kwacha on computers and on office equipment, 5,500 kwacha. Selling and administration expenses from the workings came to 302,105. Increase in allowance for receivables becomes an expense. It appears under expenses. Then the decrease in allowance for receivables appears as income. Here it was supposed to be added to this amount as income if it was a decrease in allowance, but we had increase in allowance. All right, so it's an expense. So the total expenses to be deducted came to this amount. If you deduct this from the sales, that's how we came out to 332,000 kwacha as our operating net profit. Okay, so from the operating profit, this one, that's where now the issues to do with the partnership is coming. That's where the issues to do with the partnership is coming. So the first thing you do in partnership after you've calculated the operating profit, you need to add the interest on drawings. The figures we had on the interest on drawings for Banda, Hara, and Zuru, the charges they were charged for withdrawing the money from the business, if you add their interest on drawings, came to 3,700. Okay. When you withdraw funds from the partnership will charge you for withdrawing. So this is the amount. You add it back because it's supposed to be shared amongst the partners. And then here you subtract partnership salaries. This you are subtracting because it's not shared amongst the partners. So the salaries we had was only for Hara and Zuru, 2 partners only. The other one is not paid any salary. So you subtract that one. And then the next one is the interest on capitals. You subtract. This is not shared in partnership because it goes directly to each partner. You need to subtract it. Then you come up with the residue profit. This figure now is the one which is supposed to be shared according to the profit sharing ratio. Profit sharing ratio, of which the ratio for Banda is 5, for Hara is 2, Zulu is 3. So the total of these ratios, 5 plus 2 plus 3, is 10. That's why we're having the base 10 there. Then you calculate 5 over 10 times the residue profit, this one, the one they are sharing. So these are the figures coming from the ratios that the partnership shares the profit or the loss. So these figures, they are coming up to this one, indicating that the whole profit was shared in those ratios. Okay, that's it I had to explain.